Hey everyone, Tyler here. Mortgage rates this week jumped to over 5%. And it is staggering to think that there really potentially could be no end in sight. So in this video, I want to share with you what's going on, what happened, how did we get here, and how can you prepare for what may come down the road. So let's go ahead and get started. Right here is the article from the Mortgage Daily News where they talked about how the 30-year mortgage rate jumped to 5.25% earlier this week. What they indicated here was that this is not an overstatement for how big and how fast things have been coming, because it has not happened this quickly since 1994. And as you can see here, here's where interest rates were. And back in August, we had some of July, August, some of the lowest rates we have ever seen at 2.78%. And in less than a year, we have over doubled that number to where as of yesterday, we're at 5.15% for a mortgage rate. Now, is this going to continue? Is it going to subside? And really, I needed to answer the question for myself. So the Federal Reserve, or what we call as the Feds, they raise and lower rates to try to persuade inflation and employment to remain in a certain range. And that range typically is anywhere from 2 to 2.5%. Now, with this type of inflation, we have just back on Monday, they announced a year-over-year of inflation that increased 8% from just a year ago. So this has created a bit of a chaos on wondering, how are we getting so much inflation right now, and what is the Feds doing about it? Well, this really started back at the beginning of the pandemic. At the beginning of the pandemic, the Feds dropped the rate down to 0%. Here's a chart right here, right when the pandemic started in March of 2020, and the Feds dropped the rate from 1.58% all the way to 0 or 0.05%, and they maintained this low rate back until of March of this year. We started seeing the recovery of the stock market, the recovery of the market, and honestly, the real estate market never saw any effect except for the month of March when everything was in lockdown, but it shot back right away. Why did the Feds keep it so low? Well, in this article right here, this was on July 28th, 2021, and they indicated here that they hold the rates near zero, even though things are getting better. Here they indicated, despite the optimism about the economy, Jerome Powell said that the Fed is nowhere near considering rate hikes. And they indicated back in July of 2021 that the Feds will likely hold relative to the interest rates at least until late of 2022. And then right here they indicate this: investors are looking for clues as to when the monthly bond purchasing might start pulling back. Now, this is our other clue on why interest rates really have been hiking so quickly. It's been on monthly bond purchases. The Fed, over the course of the pandemic, have been buying these mortgage-backed securities. Really, they're artificially keeping rates low because they're creating such a demand in the bond market for this. And when there's a demand, interest rates go down. And when demand tends to cease, interest rates start going up. Here is the US 10-year Treasury. And as you can see, as it has gone up, so has interest rates. When there's a lack of demand for people buying 10-year Treasury bonds, the interest rate of it goes up. Well, there's been a huge demand because the Federal Reserve has been buying these bonds at $100 billion a month. Well, they announced that they're going to start tapering this. We knew this all along. We didn't know how much it was going to be tapering, but we found out that they're tapering at $35 billion a month. Now, that is a huge reduction in the number of bonds that they're purchasing. It's actually 9 times greater than what they did back in 2018 when they started tapering back on their bond purchases then. And this was such a huge jump or decrease in bond purchases that it causes the market to react in such a way of fear, not knowing what's going to happen, and rising interest rates. And that's one of the reasons why we are seeing such a spike in interest rates right now. It goes on to say that there are so many things that are so different about this economic and monetary cycle that past precedent may not be useful as normal. Typically, anytime you get people to report what's going on in the market, they use the past to predict what's happening in the future. But because we've never had unprecedented inflation, as well as a pandemic and a war in another country, that these circumstances are very, very unique. The most important among these that they're tracking or they're looking at is inflation data. And if it shows signs of shifting, that could take months though, and the bond market may have priced in the overabundance of caution by then. And as you can see, the overpricing because they're not sure what's going to happen. Here's that release on the 12th of April that the CPI of all items rises 1.2% in March. Gasoline, shelter, food, and indices rise. Now on a year over year, that's where we get that 8.5%, and we have to wait until the next release, which is May 11th, for us to see what type of inflation we continue to have. If we still have high inflation, we will see interest rates go higher. I've talked to some mortgage brokers that they're expecting it to go up even more. If we see inflation start to taper or we get it more under control, we can potentially see a leveling out of interest rates and potentially them start going back down. In addition to looking for those inflations and the CPI readings to go down in the following month, there was an article that was just released today that the supply chain hurdles will outlast the pandemic. One thing that is directly correlated to inflation is the supply chain issues that we've been experiencing. They indicated here, because of outsourcing, offshoring, and insufficient investment in resilience, many supply chains have become complex and fragile, and is one of the main reasons why they believe that it's going to outlast the pandemic and could cause inflation to continue to soar. If we can get these supply chain issues under control, we will see the cost of materials go back down and inflation readings go back down as well. So these are the indicators that you want to watch out for when we're looking at mortgage rates. I know it seems complicated that you have to look at all these other factors for mortgage rates, but here is going to be my suggestions on the 3 things that you can do in preparation to prepare yourself and protect yourself in the midst of rising interest rates. The first thing you can do is quite obvious, is to wait and see what's to come. If you have and are in a position to wait and not actually make those purchases right now, that's probably what I would recommend you do. In addition to that, you could look for assumable mortgages. Nobody's been talking about this yet, and it will come in center focus here in the near future. I strongly believe that assumable mortgages and sellers that want to sell their home that can allow their mortgages to be assumed by the buyer will become the go-to properties for buyers to purchase. Now, there is a caveat to this, and that being if demand remains high and there's a high demand for homes, well, assumable mortgages really won't be an option because it's easier for them to accept an offer for somebody that's getting their own loan than them having to go through the whole process with you to assume their actual mortgage. In addition to that, you have to be able to cover the mortgage balance to the purchase price. And this could be an issue, especially in the inflated market that we've been seeing, where property values have increased in 2 years over 30% in the past 2 years. If you have a mortgage balance of $200,000, it could very easily be a $275,000 to $300,000 property, and you would have to come up with that difference. Now, you may be able to talk with a bank to see if they'll cover that difference, and so you'll have to talk with them directly to see if your specific bank will do that. Third is considering adjustable rate mortgages. Now, I don't condone or recommend them because of a few reasons. However, there was an article from the Mortgage Banker Association that indicated that mortgage applications have decreased from the previous week. It showed here that the unadjustable purchase index increased 2% compared to the previous week, but was 6% lower than a year ago this same week. So we're seeing a change in the market. We're seeing, this is one of our pre-market indicators that we keep track of to see if the market is shifting. However, in this article, they showed us at the very bottom here that the average contract interest rate for a 5/1 ARM increased 4.06%. We're seeing an increase in the number of borrowers considering adjustable rate mortgages. Basically what that is they get a fixed rate for 5 years and then adjusts every year after that. Now this could be great because you get a lower interest rate, but it could be really bad after 5 years if rates are still really high and your rate now increases dramatically. And then if you want to try to refinance, you have to refinance to a fixed rate that could be really high, higher than you actually wanted to go. So these are the 3 things that you potentially could consider to prepare yourself and position yourself depending on your unique situation. And now more than ever, guys, it's so important for you to keep track of what's going on in the market, in addition to owning your home and knowing what's going on with the value of your home. Now, I made this video right here that talks about the biggest regrets home buyers are having in this current market, so be sure to watch that if you're considering buying a home. Guys, if you like videos like this, please consider subscribing, like this video. Thanks for watching. Love you all, and we'll see you in the next video.